Welcome to Group Insurance Daily Pulse, your bite-sized, rapid-fire briefing on the critical shifts impacting our sector. I'm Dorian, the distribution expert, here to highlight the strategic opportunities. And I'm Aria the Actuary, ready to dissect the underlying risks, P&L implications, and regulatory friction. Let's not waste a second. Our first headline, Aria, is a stark reminder of systemic vulnerabilities.
Indeed, Aria. Kicking off with a significant development out of Asia. Aflac Life Insurance Japan, a wholly owned subsidiary of Aflac Incorporated, has disclosed unauthorized system access between June 15th and June 25th, 2026.
Proactive incident response is one way to frame it, Dorian. Responding to a catastrophic failure of controls is another. Let's talk P&L. The immediate costs are staggering. Forensic investigation, system remediation, enhanced security infrastructure, and potential legal fees. For those 230,000 customers with exposed bank details, the liability exposure for Aflac is immense, extending beyond data protection to potential financial fraud restitution.
While the operational and financial implications are undeniable, Aria, this incident also serves as a critical, albeit painful, learning opportunity for the entire industry. For carriers, it underscores the absolute necessity of robust, multi-layered defense mechanisms, not just perimeter security, but internal segmentation and zero-trust architectures.
Competitive advantage through basic operational hygiene is a grim outlook, Dorian. The regulatory pressure from data protection authorities globally, from GDPR to state-level privacy acts, means the cost of noncompliance is continually rising. The impact on policyholder retention and new business acquisition, particularly in the group space where employers are fiduciaries for their employees' data, cannot be overstated. We're looking at potential long-term erosion of market share if this isn't managed with absolute transparency and unwavering commitment to restitution. The actuarial pricing of cyber risk needs a fundamental reevaluation across all lines of business, especially those handling high volumes of PII and financial data. This isn't just Aflac's problem. It's a systemic risk for every carrier operating in the digital age.
A sobering start, Aria, but the market continues to evolve, and scale remains a dominant factor.
Shifting gears to market consolidation, our next headline highlights a major player's ascent. Alliant Insurance Services has significantly climbed the ranks, now securing the number 4 position on Business Insurance's prestigious list of the 100 largest brokers of U.S. business. They also clinched the number 6 spot globally and maintained their number 1 standing on the largest privately owned brokers list. This isn't just a vanity metric. Alliant closed 2025 with over $5.7 billion in revenue and an astounding $55 billion in premium. This growth trajectory demonstrates immense market leverage and a powerful distribution engine for group insurance products.
Market leverage is an understatement, Dorian. This continued consolidation, while impressive in top-line figures, presents significant P&L and competitive challenges for carriers and smaller brokers. For carriers, reliance on such dominant distribution partners can erode margin.
Aria, the growth is a testament to Alliant's value proposition. For carriers, this signifies a highly efficient distribution channel with unparalleled reach across diverse market segments.
It's an attractive partner for launching new group products or penetrating new geographies. For employers, this scale translates into enhanced service, broader access to innovative solutions, and significant leverage in securing more competitive terms and comprehensive services in an increasingly complex employee benefits landscape. Smaller brokers, while facing competitive pressure, can view this as a benchmark, perhaps driving them towards strategic partnerships or specializing in niche markets to enhance their own capabilities. It's about optimizing the value chain, not stifling it. Optimizing or dominating, Dorian, the risk for carriers is becoming a price taker rather than a price maker. This necessitates carriers diversifying their distribution channels and investing in their own direct-to-employer or digital platforms to mitigate over-reliance.
A valid point on the balance of power, Aria, but innovation is also key to growth, and our next story shows a dual approach.
A powerful play that comes with substantial P&L and operational risks, Dorian. Let's dissect this.
Firstly, the acquisition of Cincinnati Benefit Solutions. What are the integration costs, cultural alignment challenges, and potential client attrition risks? Mergers, particularly in consulting, rarely achieve 100% synergy. Secondly, the AI integration. While promising, the ROI on AI tools and employee benefits is often complex to quantify. What's the development cost? The ongoing maintenance? More critically, what are the data privacy implications of AI processing sensitive employee benefits data? We're stepping into uncharted regulatory territory regarding algorithmic bias in benefit recommendations. Could an AI system inadvertently discriminate or lead to unequitable outcomes, exposing Gallagher, and by extension, their carrier partners, to significant legal and reputational risk? What are the regulatory bodies, like the DOI or ERISA, saying about AI-driven advice? This isn't just about efficiency. It's about ethical governance and compliance.
Aria, this is precisely where the industry needs to evolve. For employers, Gallagher's strategy offers the promise of more sophisticated, efficient, and personalized benefits advisory services. AI-driven tools can optimize plan design, predict utilization trends, and enhance employee engagement, leading to better outcomes and potentially lower long-term costs. For carriers, while it means increased competition from a stronger brokerage, it also signals the imperative to innovate their own offerings and integrate seamlessly with advanced broker platforms. Gallagher's forward-looking financial projections underscore confidence in this dual strategy, suggesting substantial earnings growth driven by both expanded client base and technological efficiencies. This is about leveraging technology to deliver superior value, not just consolidating power.
Superior value, perhaps, but at what risk? The cost of developing and maintaining compliant, secure AI systems is immense. Smaller brokers will struggle to compete on this technological front, potentially further consolidating market power, as we just discussed with Alliant. We need clarity on the governance framework for these AI tools. Who is liable for erroneous advice generated by an algorithm? How transparent is the decision-making process? From a P&L perspective, if the AI doesn't deliver the projected efficiencies, or if there are unforeseen legal challenges, those $3 billion earnings by 2029 could be significantly impacted. The implementation friction for both the acquired firm and the integration of AI across a large organization should not be underestimated. It's a high-reward, high-risk strategy, demanding meticulous execution and robust risk management.
High risk, high reward indeed. But innovation can also unlock entirely new market segments, as demonstrated by our next story.
A perfect segue, Aria. Our next development comes from Howden, the global insurance intermediary group, with the launch of Safer at Home on June 30th, 2026. This innovative solution provides affordable healthcare protection specifically for seafarers and their families during periods when they are off contract and not employed at sea. This targets the 1.89 million men and women who crew global vessels, many of whom are uninsured during these critical periods. The product offers accessible hospitalization cover designed for shipping companies to purchase, enhancing retention and demonstrating genuine employee value. This is a game changer for a historically underserved demographic. Historically underserved often translates to difficult to underwrite, Dorian. Let's talk about the actuarial complexities and potential P&L impact.
Aria, this is precisely the kind of market innovation that drives growth and addresses critical social needs.
For carriers, this represents a new niche market opportunity in group health and accident insurance, potentially inspiring the development of similar specialized products for other unique workforces. It's about expanding the total addressable market. For brokers, particularly those in the maritime sector, Safer at Home is a crucial new benefit that significantly enhances their value proposition to shipping companies. It moves beyond basic P&I coverage to genuine employee welfare, a powerful tool for retention in a competitive global labor market. Shipping employers gain a vital tool to improve employee satisfaction and demonstrate a commitment to their workforce's well-being, translating directly into better retention and potentially higher productivity. The product's design, focusing on hospitalization, suggests a targeted approach to essential care, keeping it affordable. Focused on hospitalization, yes, but what about the continuum of care? How does this interact with national health systems or existing emergency care protocols? The affordable aspect often means higher deductibles, copays, or limited networks, which might not fully alleviate financial stress for seafarers. The operational burden on carriers cannot be overstated. Specialized claims teams, multilingual support, and navigating complex international medical billing. There's also the moral hazard of off-contract benefits. How do you manage eligibility, duration, and potential abuse without robust verification? This requires deep expertise, substantial capital investment, and a willingness to navigate significant regulatory and operational friction. While the intent is laudable, the execution and long-term profitability remain highly speculative from an actuarial standpoint. A challenging but potentially rewarding frontier.
Our final headline brings us back to financial fundamentals.
Indeed, Aria. Our final item touches on carrier financial health. MetLife has issued a preliminary Q2 2026 variable investment income update, estimating pre-tax income of $220 million to $270 million for the quarter ending June 30th. This preliminary estimate sits against the company's full year 2026 guidance of approximately $1.6 billion pre-tax in variable investment income. While these figures are unaudited and subject to revision, it provides an early insight into their investment performance.
Preliminary, unaudited, subject to revision. These caveats are crucial, Dorian. Variable investment income, by its very nature, introduces volatility into a carrier's P&L statement. While the current estimate is within their full-year guidance, the key question is the sustainability and composition of this income.
From a distribution and client perspective, however, this preliminary update, even with caveats, offers a positive signal. It suggests MetLife's investment portfolio is performing in line with expectations, underpinning their financial stability.
Reinforces confidence is a strong statement for unaudited figures, Dorian. We need to look beyond the top-line number. What's the impact of interest rate movements on their broader fixed income portfolio? How does this variable income contribute to their overall risk-based capital, or RBC ratio? Is it sufficient to absorb unexpected claim spikes or future regulatory capital requirements? While positive, it's a snapshot, highly dependent on market conditions, and its variability means it's less predictable for long-term P&L forecasting than, say, premium income. Any significant downward revision could trigger concerns about their ability to maintain dividend payouts or stock buybacks, which in turn affects investor confidence and the cost of capital. We must maintain a rigorous, skeptical lens on these preliminary figures.
Always the actuary, Aria. But for today, that's all the time we have.
Indeed, a packed 15 minutes.
Thank you for joining us on Group Insurance Daily Pulse.
Tune in next time for more rapid-fire analysis.